My dear students, welcome back to our channel. Students, in this video I am explaining MBA first semester. Subject Accounting for Management AFM. Important long questions and answers. Let's start quick revision. First unit. First important long question is: explain the scope of financial accounting. Financial accounting is the process of recording, summarizing and reporting financial transactions of a business. The main goal of financial accounting is to provide clear and accurate financial information to external parties like investors, creditors and regulators. It follows a set of standards called Generally Accepted Accounting Principles, GAAP, to ensure consistency and reliability. The scope of financial accounting involves: 1. Recording transactions. Every business transaction, like sales, purchases, or payments, is recorded in the accounting system. For example, if a company buys office supplies, the transaction is entered into the books as an expense. 2. Classifying transactions. After recording, the transactions are grouped into categories like assets, what the company owns, liabilities, what the company owes, and equity, owner's interest in the company. For instance, money the company owes for office supplies is classified as a liability. 3. Summarizing information. The data is then summarized into financial statements. These statements include: income statement shows the company's profits or losses over a period of time, example, monthly or yearly. Balance sheet shows the company's financial position at a specific point in time, including assets, liabilities, and equity. Cash flow statement shows the inflow and outflow of cash, helping understand the company's liquidity. 4. Reporting. These financial statements are shared with external stakeholders like investors, banks, and government agencies. They use this information to make decisions, such as whether to invest in the company or lend it money. Example: imagine a small bakery. It records every sale of bread, every payment to suppliers, and all wages paid to employees. The bakery will prepare an income statement to show if it's making a profit, a balance sheet to show what it owns. Example: ovens, cash, and owes, example, loan, and a cash flow statement to show how much cash it has available to run daily operations. In conclusion, financial accounting helps businesses keep track of their financial activities and provides vital information for decision-making by external parties. Next important long question is: briefly explain different accounting concepts and conventions. Accounting concepts and conventions are basic principles that guide how financial accounting is done. They ensure consistency, reliability, and clarity in financial reporting. Here's a brief explanation of the key concepts and conventions. Accounting concepts. 1. Going concern concept. This assumes that a business will continue operating in the foreseeable future unless there's evidence to suggest otherwise. For example, if a company buys a machine, it is assumed the machine will be used for several years, not just until the next month. 2. Accrual concept. This means revenue and expenses are recorded when they occur, not when cash is received or paid. For instance, if a company provides a service in December but gets paid in January, the revenue is recorded in December when the service was provided. 3. Consistency concept. Once a company chooses a specific accounting method, it should continue using that method consistently from one period to the next. For example, if a company chooses to depreciate its assets using the straight line method, it should use the same method in the future for similar assets. 4. Prudence concept. This requires accountants to be cautious and conservative, avoiding overestimation of revenue or assets and underestimation of liabilities or expenses. For example, if a company is unsure about the collectibility of a receivable, it may set aside a provision for bad debts. 5. Matching concept. This principle states that expenses should be matched with the revenues they help generate in the same period. For instance, if a company sells goods in January, the cost of those goods should be recorded as an expense in January, even if the payment to suppliers is made in February. Accounting conventions. 1. Consistency convention. This complements the consistency concept, ensuring that the same accounting methods and principles are applied year after year for comparability. 2. Full disclosure convention. This requires companies to disclose all relevant financial information that could impact decision-making. For example, if a company is facing a lawsuit, it should disclose this in its financial statements. 3. Conservatism convention. Similar to prudence, it advises accountants to choose the least optimistic options when there is uncertainty. If a company faces a potential loss, it should record the loss even if the outcome is not yet certain. In conclusion, accounting concepts and conventions ensure that financial reports are accurate, reliable, and comparable across time and businesses, helping users make informed decisions. Next important long question is: explain in detail accounting process. The accounting process is a series of steps that businesses follow to record, summarize, and report financial transactions. This process ensures that financial information is accurate and helps stakeholders make informed decisions. Here's a detailed explanation. Steps in the accounting process. 1. Identifying transactions. The first step is to identify all financial transactions that the business carries out. These transactions could include sales, purchases, payments, or receipt of money. For example, if a business sells goods to a customer for $500, that's a transaction. 2. Recording transactions. Journalizing. After identifying the transactions, the next step is to record them in a journal. The journal is a book where all transactions are listed chronologically. For example, the sale of goods for $500 would be recorded as debit accounts receivable $500 because the business is expecting to receive money. Credit sales revenue $500 because the business earned money from the sale. 3. Posting to the ledger. After transactions are recorded in the journal, they are transferred to the general ledger. The ledger organizes the transactions into accounts like cash, accounts receivable, sales, etc. For example, the $500 sale is posted to both the accounts receivable and sales revenue accounts. 4. Preparing a trial balance. After posting all transactions, a trial balance is prepared. This is a list of all accounts with their balances to ensure that total debits equal total credits. If the trial balance doesn't match, errors in recording or posting need to be corrected. 5. Adjusting entries. At the end of the accounting period, Adjustments are made for any revenues or expenses that haven't been recorded yet. For example, if a business earned $100 in interest but hasn't recorded it yet, an adjusting entry would be made. 6. Preparing financial statements. After adjustments, the financial statements are prepared. O income statement shows the business's profits or losses over a period. O balance sheet shows the business's financial position at a specific time. O cash flow statement shows the flow of cash in and out of the business. 7. Closing the books. Finally, at the end of the accounting period, temporary accounts like revenue and expenses are closed to prepare for the next period. This step resets the accounts for the new period. Example: a bakery sells $200 worth of cakes. The transaction is recorded, posted to the ledger, adjusted for expenses like flour, and then financial statements are prepared, showing the bakery's profit. In conclusion, the accounting process helps businesses track their financial activities accurately, ensuring transparency and supporting better decision making. Prepare journal entries for the following transactions of a business called Pots for Pics in 2019. 1st August, Hashini Liar, the owner, invested 57,500 rupees cash and 32,500 rupees of photography equipment in the business. 4th August, paid 3,000 rupees cash for an insurance policy. 7th August, services are performed and clients are billed for 10,000 rupees received in cash. 13th August, purchased office supplied for 1,400 rupees with cash. 20th August, received 2,000 rupees cash for interest. 24th August, paid 15,000 rupees towards salaries. 29th August, in addition, the business acquires photography equipment. The purchase price is 1 lakh rupees, pays 25,000 rupees cash and signs a note for the balance. Here are the journal entries for the transactions of Pots for Pics in 2019. Journal entries. 1. 1st August, Hashini Iyer, the owner, invested 57,500 rupees cash and 32,500 rupees of photography equipment in the business. Debit, cash 57,500 rupees. Debit, photography equipment 32,500 rupees. Credit, owner's capital 90,000 rupees. Hashini's investment in the business, both cash and equipment. 2. 4th August, paid 3,000 rupees cash for an insurance policy. Debit, prepaid insurance 3,000 rupees. Credit, cash 3,000 rupees. Paid cash for the insurance policy, recorded as an asset until the insurance is used. 3. 7th August, services are performed and clients are billed for 10,000 rupees. Received in cash. Debit, cash 10,000 rupees. Credit, service revenue 10,000 rupees. The business performs services and receives cash from clients. 4. 13th August, purchased office supplies for 1,400 rupees with cash. Debit, office supplies 1,400 rupees. Credit, cash 1,400 rupees. Office supplies were purchased and paid for in cash. 5. 20th August, received 2,000 rupees cash for interest. Debit, cash 2,000 rupees. Credit, interest income 2,000 rupees. The business receives cash for earned interest. 6. 24th August, paid 15,000 rupees towards salaries. Debit, salaries expense 15,000 rupees. Credit, cash 15,000 rupees. The business pays cash for salaries. 29th August, the business acquires photography equipment. The purchase price is 1 lakh rupees, pays 25,000 rupees cash, and signs a note for the balance. Debit, photography equipment 1 lakh rupees. Credit, cash 25,000 rupees. Credit, notes payable 75,000 rupees. The business purchases photography equipment, paying part in cash and the rest on credit through a note. Summary. These journal entries reflect the transactions in pots for PICs during August 2019, recording both cash and credit transactions for assets, liabilities, expenses, and revenues. Prepare trial balance for the following balances as on 31st March 2021. Balances. Rupees. Cost of goods sold 5 lakhs. Opening stock. Closing stock. 50,000. 50,000. Salary and wages. Sales. 50,000. 8 lakhs. Plant and machinery 2 lakhs. Drawings. Investment. 50,000. 4 lakhs. Creditors. Capital. 1 lakh. 4 lakhs. To prepare a trial balance, we list all the accounts and their balances, whether debit or credit. The total debits should equal the total credits. Here's how the trial balance would look for 31st March 2021 based on the given balances. Trial balance as on 31st March 2021. Explanation. Assets, example, plant and machinery, investment, and expenses, example, cost of goods sold, salary and wages, are debited. Liabilities, example, creditors, and revenue, example, sales, are credited. The opening stock is debited because it's an asset, while closing stock is credited since it reduces the cost of goods sold. In this trial balance, the total debits, 12 lakhs 50,000 rupees, match the total credits, 12 lakhs 50,000 rupees, confirming that the books are balanced. Next, second unit. Second unit. First important long question is: distinguish between capital expenditure and revenue expenditure. Capital expenditure, CapEx, and revenue expenditure, RevEx, are two types of business expenses that differ in terms of their purpose, duration, and impact on financial statements. Capital expenditure, CapEx. Capital expenditure refers to money spent on acquiring, upgrading, or improving long-term assets that will provide benefits to the business for many years. These assets are usually physical things like property, machinery, or equipment. Purpose: to acquire or improve assets that will last more than a year. Examples: purchasing a new delivery truck for a business, installing new machinery in a factory, building a new office or upgrading the existing one. Impact on financial statements: CapEx is not fully charged to the income statement as an expense right away. Instead, the cost is spread over the life of the asset through depreciation, if it's a tangible asset. Only the depreciation is recorded as an expense each year. Revenue expenditure, RevEx. Revenue expenditure refers to expenses incurred for the day-to-day running of the business. These costs are short-term in nature and provide immediate benefits, typically consumed within a year. Purpose: to maintain or run business operations on a day-to-day basis. Examples: paying salaries to employees, purchasing raw materials for production, paying for utilities like electricity and water. Impact on financial statements. RevEx is fully charged as an expense on the income statement in the period it occurs. It reduces the company's profit for that period. Key differences. In simple terms, capital expenditure helps the business grow and acquire long-term assets, while revenue expenditure supports its ongoing operations and is expensed immediately. Both are essential for a business's success, but they are treated differently in accounting. Next important long question is, what do you mean by depreciation? Explain different methods of depreciation. Depreciation is the process of allocating the cost of a long-term asset over its useful life. Over time, assets like machinery, buildings, and vehicles lose value due to wear and tear, age, or obsolescence. Depreciation helps businesses spread out the cost of an asset and match it with the revenue it generates. It is recorded as an expense on the income statement and reduces the asset's value on the balance sheet. Different methods of depreciation. 1. Straight line method. This is the simplest and most commonly used method. Under this method, the asset's cost is evenly spread out over its useful life. Formula. Example, if a machine costs 50,000 rupees, has a salvage value of 5,000 rupees, and a useful life of 5 years, depreciation per year is equal to, the machine will lose 9,000 rupees in value each year. 2. Declining balance method. This method applies a fixed percentage rate to the asset's book value, cost minus accumulated depreciation. More depreciation is charged in the early years. Formula. Example, if a machine's cost is 50,000 rupees and the depreciation rate is 20%, the first year's depreciation will be 50,000 by 20% is equal to 10,000. In the second year, the depreciation is calculated on 40,000 rupees, 50,000, 10,000, and so on. 3. Units of production method. This method bases depreciation on the asset's usage or output rather than time. It is suitable for assets like vehicles or machines that wear out based on how much they are used. Formula. Example, if a machine costs 50,000 rupees, has a salvage value of 5,000 rupees and is expected to produce 100,000 units, the depreciation per unit will be 0.45 per unit. If 10,000 units are produced, the depreciation for that period would be rupees 4,500. Conclusion. Depreciation allows businesses to account for the reduction in the value of their assets. The method chosen depends on how the asset is used, and each method has its advantages. The straight line method is simple, the declining balance method gives higher depreciation in early years, and the units of production method is based on actual usage. All of them help businesses manage their finances and taxes efficiently. Next important long question is, explain the provisions of the Indian Companies Act regarding preparation and presentation of financial statements. The Indian Companies Act, 2013 sets out the legal framework for how companies should prepare and present their financial statements. These provisions ensure transparency, accuracy, and consistency in financial reporting for companies operating in India. Here's an easy-to-understand explanation of the key provisions. 1. Preparation of financial statements. The Companies Act requires every company to prepare the following financial statements annually. Balance sheet shows the financial position of the company at a specific point in time, including assets, liabilities, and equity. Profit and loss account, income statement shows the company's performance over a period, including revenues, expenses, and profits or losses. Cash flow statement shows the inflow and outflow of cash during the period, highlighting liquidity. Statement of changes in equity shows changes in the company's equity during the period. These statements must be prepared in compliance with the Indian accounting standards, Ind AS, or generally accepted accounting principles, GAAP, depending on the size and nature of the company. 2. Accounting records. Every company must maintain accurate and up-to-date accounting records that reflect its financial transactions. These records should be kept in such a way that the financial statements can be prepared from them. The books must be signed off by the directors and must be maintained for a minimum of 8 years. 3. Board approval. The financial statements must be approved by the company's board of directors before they are presented to shareholders. This ensures that the financial data is accurate and reflects the true state of the business. 4. Auditing of financial statements. The financial statements must be audited by an independent auditor. The auditor's role is to check the accuracy of the financial statements and provide an audit report. For private companies with a certain size, auditing is mandatory under the Companies Act. 5. Filing with registrar. After approval by the board and auditing, the financial statements must be filed with the Registrar of Companies, ROC, along with the auditor's report within a certain time frame, usually within 30 days after the annual general meeting. Example: for a company like ABC PVT Limited, its financial statements for the year 2020-2021 would include a balance sheet showing its assets and liabilities, an income statement showing profits, a cash flow statement tracking cash movement, and changes in equity reflecting the shareholders' investments. Conclusion: the provisions of the Indian Companies Act ensure that companies maintain transparency, consistency, and accuracy in their financial reporting. By following these provisions, companies provide stakeholders with trustworthy information. Next important long question is: the following trial balance has been extracted from the books of M.S. Ramprasad and Sons. Adjustments: provide on capital at 5% per annum. Depreciate machinery at 10%. Wages outstanding amount to 50 rupees. Rent prepaid is 100 rupees. Closing stock is 8,000 rupees. To prepare the adjusted trial balance and make the necessary adjustments, we need to follow these steps. 1. Adjustment for interest on capital. Interest on capital is to be provided at 5% per annum on the capital of rupees 9,000. Interest on capital is equal to 9,000 by 5% is equal to 450 rupees. 2. Depreciation on machinery. Depreciation on machinery is to be provided at 10% on the cost of machinery. 4,000 rupees. Depreciation on machinery is equal to 4,000 by 10% is equal to 400 rupees. 3. Wages outstanding. Wages outstanding amount to 50 rupees. This means we need to add 50 rupees to the Wages expense. 4. Rent prepaid. Rent of 100 rupees is prepaid, so we need to subtract 100 rupees from the rent expense. 5. Closing stock. The closing stock is 8,000 rupees. This will be added to the trial balance. Adjustments journal entries. 1. Interest on capital. Debit, interest on capital 450 rupees. Credit, capital 450 rupees. 2. Depreciation on machinery. Debit, depreciation on machinery 400 rupees. Credit, machinery 400 rupees. 3. Wages outstanding. Debit, wages 50 rupees. Credit, outstanding wages 50 rupees. 4. Rent prepaid. Debit, prepaid rent 100 rupees. Credit, rent 100 rupees. 5. Closing stock. Debit, closing stock 8,000 rupees. Credit, trading account 8,000 rupees. Adjusted trial balance. Explanation. Interest on capital and depreciation on machinery are added to the adjusted trial balance as expenses. Wages outstanding increases the wages expense. Rent prepaid reduces the rent expense. Closing stock is added as it reduces the cost of goods sold. The adjusted trial balance is now balanced, with total debits and credits both, amounting to 29,950 rupees. Next important long question is: the following balances were extracted from the books of Thomas as on 31st March 2019. Additional information. Closing stock 9,000 rupees. Provide depreciation at 10% on machinery. Interest accrued on investment 2,000 rupees. To prepare the adjusted trial balance based on the provided information, we need to make the necessary adjustments to the balances. Adjustments. 1. Closing stock. Closing stock is 9,000 rupees. This will be added to the trial balance as it reduces the cost of goods sold. 2. Depreciation on machinery. Depreciation on machinery is to be provided at 10% of the machinery's cost, which is 30,000 rupees. Depreciation is equal to 30,000 by 10% is equal to 3,000 rupees. 3. Interest accrued on investments. Interest on investments is 2,000 rupees and needs to be added to the accrued income. Journal entries for adjustments. 1. Closing stock. Debit, closing stock 9,000 rupees. Credit, trading account 9,000 rupees. Closing stock reduces the cost of goods sold. 2. Depreciation on machinery. Debit, depreciation on machinery 3,000 rupees. Credit, machinery 3,000 rupees. Depreciation reduces the value of machinery. 3. Interest accrued on investment. Debit, accrued interest 2,000 rupees. Credit, interest income 2,000 rupees. Accrued interest increases income. Adjusted trial balance. Explanation. The closing stock of 9,000 rupees reduces the cost of goods sold and is added to the trial balance. Depreciation on machinery reduces the value of machinery and is charged as an expense. Interest on investments is added as accrued income. The adjusted trial balance is now balanced, with total debits 2,11,000 rupees equal to total credits 2,11,000 rupees. Next, third unit. Third unit. First important long question is: define ratio analysis. What is the importance of ratio analysis in Analyzing the financial performance. Ratio analysis is a method used to evaluate and interpret the financial performance of a business by analyzing various relationships between figures in its financial statements. It involves calculating different ratios using numbers from the income statement and balance sheet, which helps in assessing the company's profitability, liquidity, efficiency, and solvency. Importance of ratio analysis. 1. Assessing profitability. Ratios like the net profit margin and return on assets show how well a company is generating profit from its revenues and assets. Example, if a company has a net profit margin of 20%, it means that for every 100 rupees of sales, 20 rupees is profit. Importance. This helps in understanding how efficient the company is at converting sales into actual profit. 2. Evaluating liquidity. The current ratio and quick ratio measure the company's ability to meet its short-term obligations with its short-term assets. Example, a current ratio of 2 means that the company has 2 rupees in assets for every 1 rupee in liabilities. Importance. These ratios help investors and creditors assess whether the company can pay off its short-term debts without facing financial difficulty. 3. Assessing efficiency. Ratios like the inventory turnover and receivables turnover help in evaluating how efficiently the company is using its resources, like inventory and receivables. Example, an inventory turnover ratio of 5 means that the company sells and replaces its inventory 5 times in a year. Importance. Efficient use of resources leads to better financial health and higher profits. 4. Evaluating solvency. The debt-to-equity ratio compares a company's debt to its equity to understand its financial leverage and long-term solvency. Example, a debt-to-equity ratio of 0.5 means the company uses rupees 0.50 of debt for every 1 rupee of equity. Importance. It indicates the level of risk the company faces in terms of its ability to meet long-term financial obligations. Conclusion. Ratio analysis is a valuable tool for both internal management and external stakeholders, such as investors and creditors. By analyzing different ratios, one can gauge a company's financial health, performance trends, and areas that need improvement. It simplifies complex financial data, making it easier to make informed business decisions. Next important long question is: explain the classification of ratios. Classification of ratios refers to grouping financial ratios into categories based on what aspect of a company's performance they measure. These ratios help analyze the company's profitability, liquidity, efficiency, and financial stability. Here are the main classifications of financial ratios. 1. Liquidity ratios. These ratios measure a company's ability to pay off its short-term liabilities using its short-term assets. Current ratio. It shows how many times a company's current assets can cover its current liabilities. Formula: current ratio is equal to current assets current liabilities. Example, if a company has current assets of 50,000 rupees and current liabilities of 25,000 rupees, the current ratio is 2. This means the company has 2 rupees in assets for every 1 rupee in liabilities. Quick ratio. Also called the asset test ratio, it excludes inventory from current assets to measure liquidity more conservatively. Formula: quick ratio is equal to current assets inventory, current liabilities. Example: if a company has 50,000 rupees in current assets, 10,000 rupees in inventory, and 25,000 rupees in current liabilities, the quick ratio is 1.6. This indicates the company can meet its liabilities without relying on inventory. 2. Profitability ratios. These ratios measure a company's ability to generate profit relative to its sales, assets, or equity. Net profit margin. It shows what percentage of sales is profit after all expenses. Formula: net profit margin is equal to net profit sales times 100. Example: if a company earns a net profit of 20,000 rupees from sales of 100,000 rupees, the net profit margin is 20%. Return on assets (ROA). It shows how efficiently a company uses its assets to generate profit. Formula: ROA is equal to net income total assets times 100. Example: if a company has a net income of 10,000 rupees and total assets of 50,000 rupees, the ROA is 20%. 3. Efficiency ratios. These ratios measure how effectively a company uses its resources. Inventory turnover. It shows how many times a company sells and replaces its inventory during a period. Formula: inventory turnover is equal to cost of goods sold average inventory. Example: if a company sells 100,000 rupees worth of goods and has an average inventory of 20,000 rupees, the turnover is 5 times. Receivables turnover. It shows how efficiently a company collects money from customers. Formula: receivables turnover is equal to net credit sales average accounts receivable. Example: if net credit sales are 200,000 rupees and average accounts receivable are 40,000 rupees, the turnover is 5. 4. Solvency ratios. These ratios evaluate a company's ability to meet its long-term debts. Debt-to-equity ratio. It shows the proportion of debt used to finance the company's assets in relation to shareholders' equity. Formula: debt-to-equity is equal to total debt total equity. Example: if a company has 100,000 rupees in debt and 50,000 rupees in equity, the ratio is 2, meaning it has 2 rupees of debt for every 1 rupee of equity. Conclusion: ratios are valuable tools for analyzing a company's financial health. By classifying them into liquidity, profitability, efficiency, and solvency, we can get a clear picture of how well a company is performing in various areas. These ratios help investors, managers, and creditors make informed decisions about the company's future. Next important long question is: the working capital of ABC Ltd has deteriorated in recent years and now stands as under. Calculate. Current ratio, 2. Quick ratio, 3. Inventory to working capital, 4. Debt to equity ratio, proprietary ratio, 6. Current assets to fixed assets. Let's break down the calculation of the ratios step by step. We are given the following data. Current assets. Land and buildings, 1,40,000 rupees. Plant and machinery, 3,50,000 rupees. Stock, 2 lakhs rupees. Sundry debtors, 1 lakh rupees. Bills receivable, 10,000 rupees. Cash at bank, 40,000 rupees. Total current assets is equal to 8,40,000 rupees. Current liabilities. Share capital, 2 lakhs rupees. Profit and loss AC, 30,000 rupees. General reserve, 40,000 rupees. 12% debenture, 4,20,000 rupees. Sundry creditors, 1 lakh rupees. Bills payable, 50,000 rupees. Total current liabilities is equal to 8,40,000 rupees. Formulas. 1. Current ratio. Calculations. I. Current ratio equal to 1. 2. Quick ratio. Quick ratio is equal to 0.76. 3. Inventory to working capital. Working capital is equal to 0 rupees. Since the current assets and current liabilities are equal, working capital is 0. Inventory to working capital is equal to 2 lakhs 0. This is undefined since the working capital is 0. 4. Debt to equity ratio 1.74. V. Proprietary ratio is equal to 0.20. 6. Current assets to fixed assets ratio equal to 1.71. Summary of results. 1. Current ratio is equal to 1. 2. Quick ratio is equal to 0.76. 3. Inventory to working capital is equal to undefined due to 0 working capital. 4. Debt to equity ratio is equal to 1.74. 5. Proprietary ratio is equal to 0.20. 6. Current assets to fixed assets ratio is equal to 1.71. Next important long question is: XYZ company reports the following figures. Net sales, 5 lakhs rupees. Cost of goods sold, 3 lakhs rupees. Operating expenses, 1,20,000 rupees. Net income, 80,000 rupees. Calculate the following profitability ratio: gross profit margin, operating profit margin and net profit margin. To calculate the profitability ratios for XYZ company, we can use the following formulas. 1. Gross profit margin. 2. Operating profit margin. 3. Net profit margin. Given data. Net sales is equal to 5 lakhs rupees. Cost of goods sold, COGS, is equal to 3 lakhs rupees. Operating expenses is equal to 1,20,000 rupees. Net income is equal to 80,000 rupees. Step-by-step calculation. 1. Gross profit. 2. Gross profit margin is equal to 40%. 3. Operating profit. 4. Operating profit margin is equal to 16%. 5. Net profit margin is equal to 16%. Summary of results. 1. Gross profit margin is equal to 40%. 2. Operating profit margin is equal to 16%. 3. Net profit margin is equal to 16%. Next important long question is: gross profit. Prepare the balance sheet. To prepare the balance sheet, we can extract the required figures and use sum of the ratios provided to calculate the values for assets, liabilities, and equity. Let's break down the problem and proceed step by step. Given data. 1. Gross profit, GP, is equal to 54,000 rupees. 2. Shareholders' equity is equal to 6 lakhs rupees. 3. Gross profit margin is equal to 20%. 4. Credit sales to total sales is equal to 80%. 5. Total assets turnover is equal to 4 times. 6. Average collection period is equal to 20 days. 7. Current ratio is equal to 1.8. 8. Long-term debt to equity ratio is equal to 40%. 9. Year is equal to 360 days. Step-by-step calculations. 1. Total sales calculation. Given the gross profit margin of 20%, we can calculate the total sales as follows. 2. Cost of goods sold, COGS. 3. Credit sales calculation. 4. Accounts receivable, AR, calculation. From the average collection period, 20 days, we can calculate the accounts receivable. The formula to calculate AR is 5. Total assets calculation. The total assets turnover ratio is given as 4 times, which means 6. Current liabilities calculation. Using the current ratio of 1.8, we can calculate the current liabilities. To calculate the current assets, we need to look at the structure of current assets. We know that accounts receivable, AR, is 12,000 rupees. Assuming that current assets include AR, cash, and inventories, let's take a reasonable assumption for total current assets to be equal to the total assets, since the current ratio calculation is involved with both. 7. Debt to equity calculation. Given the long-term debt to equity ratio is 40%, we can find the long-term debt using the formula. 8. Liabilities and equity. We know that total liabilities are equal to long-term debt plus current liabilities. The total equity is 6 lakhs rupees and long-term debt is 2,40,000 rupees. So, the current liabilities can be inferred by balancing out the total assets equation. The balance sheet. Here's a simple structure based on the given data. Next, fourth unit. Fourth unit. First important long question is: what are the advantages and utilities of cash flow statement? A cash flow statement is an important financial document that shows how cash moves in and out of a business over a specific period. It helps both business owners and outside parties understand the company's liquidity, that is, its ability to meet short-term obligations with the cash available. Advantages of a cash flow statement. 1. Tracks cash movement. A cash flow statement helps businesses track how much cash is coming in and going out. This is important because even if a company shows high profits on paper, it might not have enough cash to pay bills or reinvest in its operations. For example, a company might sell products on credit, but it still needs cash to pay suppliers. 2. Helps in decision making. Business owners and managers use cash flow statements to make informed decisions about spending, investments, and financing. If a company is running low on cash, they might delay some payments or consider taking out a loan. For instance, if a company sees that it is spending more than its earnings, it may decide to cut expenses or find ways to boost sales. 3. Shows financial health. The statement reveals the financial health of a company. If a company has a positive cash flow, it means it is generating more cash than it spends, which is a sign of financial stability. On the other hand, consistent negative cash flow might indicate trouble. For example, if a business is unable to pay off its debt on time, it could face bankruptcy. 4. Helps investors and creditors. Investors and creditors use cash flow statements to evaluate whether a business is a good investment or loan risk. If the company consistently generates positive cash flow, it signals to investors that their money is being managed well. Conversely, negative cash flow could signal potential risks. Example: imagine a small coffee shop. In the cash flow statement, you see that cash from Customers' cash inflow is steady, but the cash spent on supplies, rent and wages, cash outflow, is growing. The shop can use this information to decide if it should raise prices or reduce expenses to stay profitable. Conclusion. In short, the cash flow statement is a vital tool that helps businesses, investors, and creditors understand how cash moves within a company. It offers clarity on liquidity, ensures better financial planning, and supports informed decision making. Next important long question is: discuss the application areas of various tax planning and how it is different from avoidance and evasion. Tax planning. Tax planning is the process of arranging your financial affairs in such a way that you can minimize your tax liability within the legal framework. It involves using tax-saving strategies, deductions, exemptions, and credits to ensure that you don't pay more taxes than necessary. Application areas of tax planning. 1. Income tax planning. Individuals and businesses can plan their income in a way that reduces their taxable income. For example, investing in government-approved schemes like PPF, Public Provident Fund, or ELSS, equity-linked savings scheme, allows taxpayers to get deductions under Section 80C of the Income Tax Act. 2. Corporate tax planning. Companies can plan their expenses and investments to reduce their tax burden. For instance, a company might invest in research and development (R&D) to claim deductions or set up operations in regions with lower taxes. 3. Capital gains tax planning. Planning the sale of assets like property or stocks can help reduce capital gains tax. For example, holding an asset for more than a year before selling it may qualify for lower tax rates, as long-term capital gains are taxed at a reduced rate compared to short-term gains. 4. Estate tax planning. Individuals can plan how to pass on their estate to beneficiaries in a way that minimizes estate taxes. This may involve gifting assets or setting up trusts. Tax avoidance versus tax evasion. Tax avoidance. Tax avoidance is the legal use of tax laws to reduce one's tax burden. It involves taking advantage of deductions, exemptions, and loopholes in the tax system. For example, contributing to a retirement plan or using tax-free investment options like municipal bonds is tax avoidance. It's legal and ethical, but some tax avoidance strategies can be complex. Tax evasion. Tax evasion is the illegal act of deliberately misrepresenting or concealing information to reduce tax liability. For example, not declaring income or inflating expenses to lower taxable income is tax evasion. It's illegal and can lead to penalties or criminal charges. Conclusion. In summary, tax planning helps individuals and businesses minimize taxes within the law through legal deductions and strategies. In contrast, tax avoidance is also legal but involves using loopholes or complex strategies, while tax evasion is illegal and involves dishonest actions. Tax planning ensures you are compliant with the law while reducing your tax burden, providing a balance between financial efficiency and legality. Next important long question is: what do you mean by cost? Explain the classification of cost. What is cost? Cost refers to the total amount of money spent to produce or acquire something. It includes all the expenses a business or individual incurs to make a product or offer a service. In simple terms, cost is what you pay to get something done or created. For example, if you run a bakery, the cost includes ingredients, flour, sugar, etc., rent, salaries of employees, and utility bills that are needed to bake the bread and cakes you sell. Classification of cost. Costs are classified in various ways based on their nature and behavior. Here are the main types of cost. 1. Fixed costs. These are costs that do not change regardless of how much you produce or sell. They remain constant over time. Example, rent for your bakery, insurance, or salaries of permanent staff. Whether you bake 10 cakes or 100 cakes, the rent remains the same. 2. Variable costs. These are costs that change based on the level of production or business activity. The more you produce, the higher the variable costs. Example, the cost of ingredients, flour, sugar, etc. increases as you bake more cakes. If you bake 100 cakes, you need more ingredients than if you only bake 10 cakes. 3. Semi-variable costs. These costs have both fixed and variable components. They might remain fixed up to a certain level of production and then increase after a certain point. Example, electricity bills. You pay a fixed amount every month, but if your bakery produces more cakes, increased machinery usage, the electricity cost will rise. 4. Direct costs. These are costs that can be directly traced to the production of a specific product or service. Example, the cost of ingredients used to make cakes, flour, sugar, etc. is a direct cost because it can be directly attributed to each cake made. 5. Indirect costs, overhead costs. These are costs that cannot be directly traced to a specific product or service but are necessary for running the business. Example, rent, utilities, or administrative salaries are indirect costs because they support the bakery but can't be tied to any specific product. Conclusion. In simple terms, cost is the money spent to produce or acquire something. The classification of costs helps businesses better understand their spending and manage their expenses. Fixed costs stay the same regardless of production, while variable costs change with production. Direct costs are linked to specific products, and indirect costs are general expenses necessary for business operations. Understanding these classifications helps businesses control costs and maximize profits. Next important long question is: explain the preparation of cost sheet with the help of pro forma. What is a cost sheet? A cost sheet is a detailed statement that shows the total cost incurred in the production of goods or services. It helps businesses understand how much it costs to produce a product, which is useful for pricing, budgeting, and controlling costs. A cost sheet breaks down all the costs associated with manufacturing a product, including raw materials, labor, and overheads. Pro forma of a cost sheet. A pro forma cost sheet helps in structuring the information in an organized manner. Below is the basic format, pro forma, of a cost sheet. Cost sheet format. Example of a cost sheet. Imagine a small company, XYZ Limited, that produces handmade candles. The company wants to prepare a cost sheet for 1 month's production. 1. Direct costs. Direct materials, wax, wick, etc. is equal to 10,000 rupees. Direct labor, wages of workers, is equal to 5,000 rupees. Direct expenses, packaging, is equal to 2,000 rupees. Total prime cost is equal to 10,000 rupees plus 5,000 rupees plus 2,000 rupees is equal to 17,000 rupees. 2. Factory costs. Factory overheads, rent, utilities, is equal to 3,000 rupees. Total factory cost is equal to 17,000 rupees plus 3,000 rupees is equal to 20,000 rupees. 3. Cost of production. Opening stock of finished goods is equal to 2,000 rupees. Closing stock of finished goods is equal to 1,000 rupees. Cost of production is equal to 20,000 rupees plus 2,000 rupees to 1,000 rupees is equal to 21,000 rupees. 4. Cost of sales. Administrative expenses is equal to 1,000 rupees. Selling and distribution expenses is equal to 1,500 rupees. Total cost of sales is equal to 21,000 rupees plus 1,000 rupees plus 1,500 rupees is equal to 23,500 rupees. 5. Selling price. Assume the company sells candles for 30 rupees each and produces 1,000 candles. Selling price is equal to 30 rupees times 1,000 is equal to 30,000 rupees. Conclusion. A cost sheet helps businesses track and control costs by clearly categorizing expenses. By following the pro forma structure, businesses can easily calculate the total costs involved in producing a product and determine its selling price. This process ensures profitability and better decision-making for pricing and cost management. Next important long question is: following is the balance sheet of Wilson as on 31st March 2020 and 2021. During 2021, a piece of machinery of the book value of 80,000 rupees was sold for 65,000 rupees. Depreciation provided on fixed assets during the year amounted to 2 lakhs rupees. Prepare a cash flow statement. To prepare a cash flow statement for Wilson for the year 2021, we will follow the indirect method, which starts with the net profit and adjusts for changes in working capital, non-cash items, and other operating activities. Step 1. Calculate net profit before changes in working capital. We are given the balance sheets for 2020 and 2021. We'll need to calculate the net profit based on the changes in assets and liabilities. Net profit calculation. 1. Sale of machinery. Book value of machinery is equal to 80,000 rupees. Sale price of machinery is equal to 65,000 rupees. Loss on sale of machinery is equal to 80,000 rupees to 65,000 rupees is equal to 15,000 rupees. 2. Depreciation on fixed assets. Depreciation is equal to 2 lakhs rupees. Non-cash expense will be added back to the cash flow. Step 2. Changes in working capital. Working capital is calculated as current assets, current liabilities. Let's calculate the changes in working capital between 2020 and 2021. 1. Current assets. 2. Current liabilities. Decrease in current liabilities, which is a source of cash. Step 3. Cash flow from operating activities. We start with the net profit and adjust for changes in working capital and non-cash items like depreciation and loss on sale of machinery. Cash flow from operating activities, indirect method. Step 4. Cash flow from investing activities. Step 5. Cash flow from financing activities. Step 6. Preparing the cash flow statement. Now, to calculate the actual figures, we can sum up the changes based on the adjustments and ending cash. Operating activities. Net cash flow from operating activities will be calculated by adding and subtracting the values for depreciation, loss on sale of machinery, and changes in working capital. Financing activities and investing activities are straightforward. Once the totals are calculated, we will arrive at the final cash balance at the end of the period. Next, fifth unit. Fifth unit. First important long question is: explain managerial uses of break-even concept. Managerial uses of the break-even concept. The break-even point, BP, is a critical concept in business that helps managers understand the level of sales at which a company's total revenue equals its total costs, resulting in neither profit nor loss. In simpler terms, it's the point where a business breaks even, covering all its costs but not yet making a profit. Managers use this concept to make informed decisions about pricing, cost control, and financial planning. Managerial uses of break-even concept. 1. Setting sales targets. Managers can use the break-even point to set realistic sales targets. For example, if the break-even point is 1,000 units, the manager knows that they need to sell at least 1,000 units to cover all fixed and variable costs. Any sales above this point will contribute to profits. Example: if a company has fixed costs of 50,000 rupees and the selling price per unit is 100 rupees, with variable costs per unit of 60 rupees, the break-even point is calculated as is equal to 1,250 units. This means the company needs to sell 1,250 units to break even. 2. Pricing decisions. Break-even analysis helps managers determine the right price for a product by understanding how costs change with price adjustments. Managers can set a price that covers costs and provides a margin for profit. Example: if the manager wants to increase profit, they may consider raising the selling price or reducing variable costs. A small change in either can significantly impact the break-even point. 3. Cost control. Break-even analysis also helps managers identify areas where they can reduce costs. If fixed or variable costs are too high, managers may consider ways to lower them to achieve profitability faster. 4. Profit planning. By understanding how much sales are required to cover costs, managers can plan for different profit levels. For instance, if a company wants a profit of 20,000 rupees, they can calculate the additional sales needed above the break-even point. Conclusion: the break-even concept is a valuable tool for managers to plan and make key business decisions related to pricing, cost management, and setting sales goals. It ensures that a business operates efficiently, helps avoid losses, and ultimately aids in achieving profitability. Next important long question is: sales to lakhs, profit, variable costs 60%, you are required to calculate PV ratio. 2. Fixed cost. 3. Sales volume to earn a profit of 50,000. Let's break down each part of the question step by step. Given data: sales is equal to 2 lakhs rupees. Profit is equal to 20,000 rupees. Variable cost percentage is equal to 60%. Step 1. Calculate the PV, profit volume ratio. The PV ratio is calculated as the contribution margin divided by sales. The contribution margin is the difference between sales and variable costs. Formula for PV ratio. First, calculate the contribution margin. Now, calculate the PV ratio. Step 2. Calculate fixed cost. The fixed cost can be derived using the formula. Step 3. Calculate sales volume to earn a profit of 50,000 rupees. To find the required sales volume to earn a profit of 50,000 rupees, we use the following formula. Summary of calculations. PV ratio is equal to 40%. 2. Fixed cost is equal to 60,000 rupees. 3. Sales volume to earn 50,000 rupee profit is equal to 2,75,000 rupees. Next important long question is, from the following particulars calculate labor variances. Standard hours is equal to 200. Standard rate for actual production is equal to 1 per hour. Actual hours 190. Actual rate is equal to 1.25 per hour. To calculate labor variances, we can break down the calculation into the following components. 1. Labor rate variance, LRV. 2. Labor efficiency variance, LEV. Given data. Standard hours is equal to 200 hours. Standard rate for actual production is equal to 1 rupee per hour. Actual hours is equal to 190 hours. Actual rate is equal to 1 rupee and 25 paise per hour. Step 1. Calculate labor rate variance, LRV. The labor rate variance is the difference between the actual rate paid and the standard rate multiplied by the actual hours worked. Formula for labor rate variance, LRV. So, the labor rate variance is 47.5 rupees unfavorable. Step 2. Calculate labor efficiency variance, LEV. The labor efficiency variance is the difference between the actual hours worked and the standard hours allowed for the actual production multiplied by the standard rate. Formula for labor efficiency variance, LEV. So, the labor efficiency variance is 10 rupees favorable. Summary of variances. Labor rate variance, LRV, is equal to 47.5 rupees unfavorable. Labor efficiency variance, LEV, is equal to 10 rupees favorable. Next important long question is, a firm can purchase a separate part from an outside source at 11 rupees per unit. There is a proposal that the spare part can be produced in the factory itself. For this purpose, a machine costing 1 lakh rupees with annual capacity of 20,000 units and a life of 10 years will be required. A foreman with a monthly salary of 500 rupees will have to be engaged. Materials required will be 4 rupees per unit and wages to rupees, variable overheads are 150% of direct labor. The firm can easily raise funds at 10%. PA advise the firm whether the proposal should be accepted. Analysis of the proposal. We need to determine whether the firm should buy the spare part from an outside supplier at 11 rupee per unit or produce it in-house using the machine and other resources. To do this, we'll compare the cost of producing the part in-house with the cost of buying it from the outside source. Step 1. Cost of producing the spare part in-house. We are given the following details for producing the part in-house. Cost of machine is equal to 1 lakh rupees. Annual capacity of the machine is equal to 20,000 units. Life of the machine is equal to 10 years. Foreman salary is equal to 500 rupee per month. Material cost per unit is equal to 4 rupees. Wages per unit is equal to 2 rupees. Variable overheads is equal to 150% of direct labor. Interest rate for funding is equal to 10% per annum. 1. Depreciation on the machine. The cost of the machine is 1 lakh rupees and the machine has a useful life of 10 years. So, the annual depreciation on the machine is equal to 10,000 rupee per year. The foreman's monthly salary is 500 rupees, so the annual salary for the foreman is foreman's salary is equal to 500 times 12 is equal to 6,000 rupee per year. 3. Material costs. The material cost per unit is 4 rupees. If the firm produces 20,000 units annually, the total material cost will be 80,000 rupee per year. 4. Wages. The wages per unit produced are 2 rupees. For 20,000 units, the total wages cost will be equal to 40,000 rupee per year. 5. Variable overheads. The variable overheads are 150% of direct labor wages. So, the variable overheads will be equal to 60,000 rupee per year. 6. Interest on machine cost, financing cost. The interest on the machine cost at 10% per annum is interest on machine is equal to 10,000 rupee per year. Total in-house production cost annual. Now, let's add all the costs for in-house production. Total in-house cost is equal to 2,06,000 rupee per year. Cost per unit for in-house production. Since the machine has a capacity of 20,000 units annually, the cost per unit for in-house production will be cost per unit is equal to 10 rupees and 30 paise per unit. Step 2. Cost of purchasing from outside supplier. The cost of purchasing the part from an outside supplier is 11 rupee per unit. For 20,000 units, the total cost will be total cost of purchase is equal to 11 times 20,000 is equal to 2,20,000 rupees. Step 3. Comparison and decision. Cost of producing in-house, 2,06,000 rupee per year, 10 rupees and 30 paise per unit. Cost of purchasing, 2,20,000 rupee per year, 11 rupee per unit. Conclusion: the firm should produce the part in-house because the cost of in-house production, 2,06,000 rupees, is lower than the cost of purchasing it, 2,20,000 rupees. By producing the part in-house, the firm saves 14,000 rupees annually, 2,20,000 rupees to 2,06,000 rupees. Thus, the proposal to produce the spare part in-house should be accepted.